Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be talking about growth, inflation, and the H.O.P.E framework. So growth. GDP, gross domestic product, is the key indicator of economic growth and activity. In the first and second quarter of 2022, we had negative GDP. The first quarter was negative 1.6 and the second quarter was negative 0.6%. Most recessions need 2 consecutive quarters of negative growth, and that actually happened. But typically, again, we have at least a 0.5% uptick in unemployment. The Federal Reserve's GDP Now forecast projects third quarter GDP to actually be positive at 2.9%. So was that just a blip in the radar, or is there actually more negative GDP readings to come? So as you can see from this chart, during COVID, we had actually 2 consecutive quarters of negative GDP. One extremely drastic actually drop during that March to June quarter. And then we had this consecutive rebound in real GDP as the economy came back to life. We've had a positive number until that reading we just had in the first and second quarter of this year. So this chart is actually the Atlanta Fed real GDP indicator. And it's trying to forecast what's currently happening in this quarter, which will be eventually told to the public probably around the November timeframe. And you can see the forecast right now is forecasting a positive GDP of 2.9%. Inflation. CPI, Consumer Price Index, is the most commonly cited measure of inflation. CPI uses a basket of goods and services to track price changes for consumers. Economists focus on core CPI to measure the underlying trend in inflation. And core CPI does exclude food and energy. Currently, inflation remains at 4-decade highs and continues to weigh on economic growth and household budgets. As you look at this chart, you're seeing inflation spike in the 1970s and also in the 1980s. And currently, you're seeing similar actual trajectory of inflation. Not as high as the 70s and 80s, but at 8.2%. And that spike and elevation is what's causing a lot of anxiety and volatility in the current stock market. As we look at the components of CPI, you can see that the greatest increases have come actually from energy, transportation services, and food. The year-over-year price change in energy is about 20%, with also transportation services, which is a direct input cost of energy, at 14.6%, and food at 11.2%. Pretty much every component of CPI has been increasing over the last 12 months. The H.O.P.E framework. So H.O.P.E is an acronym and gives a roadmap for how the economy responds to changes in interest rates, especially the drastic rate increases we've seen here currently. The H stands for housing. It's the first to slow and serves as a great leading indicator. The second is orders, and that's tracked by the Institute of Supply Management data. The third to slow is companies' profits, and we'll start to see that over the next coming quarters. And lastly is employment, and that's usually the most lagging part of the economy. So this chart is just showing you that acronym of H.O.P.E. And the key here is that every single cycle goes through the H.O.P.E, which eventually leads to some form of a recession. Nobody ever knows the timing of that, but we're definitely going to go through the last 2, profits and employment, probably over the next 6 to 12 to 18 months. Thank you for joining us for 3 and 3.